Today we're going to be learning about depreciation. Depreciation is the amount an asset goes down in value as you use it. Almost everything in a company depreciates in value. Obviously, machinery like vehicles are one of the easiest ones for most students to understand because you all know that as you drive your car, the more miles you put on your car, the more the value of that car goes down. So we're going to use that as an example today, and I'm going to show you 3 depreciation methods. They're very common depreciation methods. Most companies pick one of the 3 methods and uses it for all of their items. The only thing that does not go down in value or depreciate in a company is land. So we will not have to worry about that. You buy a piece of land, you put it on your books at the amount that you paid for it, and you leave it alone until you go to sell it. Obviously, when you sell things, you can either have a gain, make more money than you thought it was worth, or a loss. If you are depreciating assets regularly, which you're supposed to do, and if you do a good job with it, hopefully you'll get around the amount that you think that asset is worth on your books for it when you sell it in the open market. But there's no guarantees. Just because you think that an asset is worth a certain amount of money doesn't mean that you can find a buyer for it. There's a saying that an asset's only as good or only worth what somebody is willing to pay for it. So we just have to make sure we have a buyer that's willing to pay what we want them to pay for the asset. Let's go through an example of the 3 types of depreciation method, assuming we buy a vehicle, I put up here a machine, that costs $120,000. Let's say this is gonna be a really nice delivery van. It's a very expensive purchase, obviously. And we think, because we're gonna put a lot of miles on it, that we'll either use the delivery van 5 years or 210,000 miles. So that's gonna be kind of our parameter for this project or this little exercise that we're doing. So 120,000 is the cost. Think we're gonna use either 5 years or 210,000 miles. I wrote down here, we're gonna show the methods for 3 years, each of these 3 methods. Each of the years I have recorded how many miles the vehicle drove. So 80,000 miles the first year, 50,000, and then 30,000. I also put a salvage value on this of 15,000. Salvage value can either be called that or residual value. Some textbooks call it residual value. Salvage value, it's the same thing. It means what you think the asset is going to be worth after you've completed your usage of it. A lot of accountants use 0 for this because they want to be conservative. But if you think there are parts that you could sell individually, then you can use that dollar amount. For this example, I did use a salvage value. A lot of the ones in your book for your homework or on your test are probably going to use 0, but I wanted you to see it with a dollar amount in there. And so we used 15,000 as the salvage value for this. All right. The first method is really easy, and in fact, in the adjusting journal entries, I think we talk about depreciation and we use straight line. So this is going to be method number 1. The straight line method is very simple and straightforward. It says take your cost of the asset, so obviously $120,000 is the cost, minus the salvage value, which I just told you we're going to use is 15,000, divided by the useful life in years, 5 years. So 120,000 minus 15,000 divided by 5 gives you 21,000 per year. So for 5 years, you're going to put 21,000 as your depreciation expense. I only showed 3 years because we're only going to do 3 in this example, but you could even for straight line write year 4 and 5, it's going to be 21,000. It's always the same number for straight line. A lot of people like this because of the simplicity of it. The only problem with straight line is that it's great for a desk or even a computer or a piece of furniture or a painting or something like that. What it's not great for is what we're doing here, a vehicle. If you drove the vehicle the same amount of miles every year, then it would be a great method, right? But we don't. Look at our example. We drove at 80,000 miles the first year, but then only 50 and then only 30. So depreciating at the exact same dollar amount every year seems a little off. It's not a bad method. And for a lot of furnitures and fixtures, it's a great method. A building or anything like that, that's a great method because you're not using it. You are using it, but you're not putting miles on it or using it per hour or something like that. So it's a fine method. very accepted in the accounting world, very straightforward, but it's not the most accurate when you're talking about miles. So the next method is very similar. Units of production says take the cost minus the salvage value. So we start out the same exact way, right? Cost minus salvage value, 120,000 minus 15,000, divided by useful life, not in years, but in miles. So in this example, we're gonna say, how many total miles do you think you'll get out of this vehicle? And we said 210,000. So 120 minus 15 over 210 gives you 50 cents. Well, you're not done because that doesn't make any sense, right? I have a lot of students who would turn that in and say, units of production is 50 cents depreciation. What? That doesn't make any sense. You have 21,000 over here and you're gonna say 50 cents and be done? No, of course not. What you do then is every year you multiply that 50 cents by how many miles you actually drove the vehicle. So for the first year, you drove it a lot of miles, 80,000 miles. 80,000 times 50 cents is 40,000. Notice how much more you would depreciate it under units of production rather than straight line, okay? So it's more accurate. Now, the next year you drove 50,000 miles, so it's only $25,000, very similar to straight line. The next year you drove it less, 30,000 miles, and it only comes out to be 15,000, so straight line actually would have been too much depreciation. So it just gives you a more accurate view of how you're actually depreciating it. It's just a more specific method for any piece of equipment where you're putting miles on it, or a piece of equipment or machinery where you're using it per hour. Then we can be a little bit more specific with units of production. So I like this method more for something that's actually being used different amounts each year. Again, straight line is perfectly acceptable, and for a lot of things that just sit there, it's great. But units of production goes a little bit further and is a little bit more specific for items that are actually used in different amounts in different years, okay? The third method that we're gonna look at today is called double declining balance. Double declining balance says take straight line, divide that by the cost minus the salvage value, and notice this is in parentheses. Then we're gonna take that and multiply it by 2. It's double declining, so we're gonna multiply it by 2. This method is great for a tax break. A lot of companies love this method, and it inspires them to spend a certain amount of money, like make a big purchase, because they know they're going to get double the depreciation expense, which means double the tax deduction in the first couple of years. What ends up happening is that at some point during its useful life, you'll get like lots of money in depreciation expense the first couple of years, but then you'll actually go below straight line the last couple of years. So it's great up front, and it gives you a really big tax break. And it's nice because you get that tax break in the year that you've written the check for the item. So you had to spend all this money on the asset, and in the same time, you're getting a big tax deduction. That's great. It will be less than straight line later on in the asset's life. Over the whole 5-year period, because that's the useful life for this, it's the same amount of depreciation whether you use straight line or double declining. It's just it's front loaded so that when you are writing a check for that asset, you get a little break in the first couple of years. So let's look at how it works. 120,000 was the cost minus the salvage value. Notice on top, we put the straight line depreciation, which we found back over here is 21,000. Divide this and multiply by 2, you get a percentage, you get 40%. What do you do with that? That means that you can actually depreciate 40% of the cost of the asset in the first year. That's a ton. So 120,000 times 40% gives you $48,000 worth of depreciation in year 1. Notice under this method, straight line, you only got 21,000. So it gives you a lot of depreciation expense, double the depreciation expense in year 1. Year 2, you take the original cost of 120, subtract the 48,000 that you just depreciated because we can't depreciate that anymore. Multiply that by 40% and you're at 28,800. That's still more than straight line. So years 1 and 2, you're more than straight line. What will happen in year 3 is you'll go below straight line. So for years 3, 4, and 5, you'll be below straight line. So it's front loaded. You get a lot of depreciation expense, which is the tax deduction in years 1 and 2. Year 3, you take 120 minus 48 minus 28.8 times 40%, and you're down to $17,280. So front loaded, get a lot of depreciation expense up front. This is great for tax purposes. Double declining is, the most popular for tax purposes, obviously. Straight line, I would say, is probably the most popular for items that are sitting there being used the exact same amount every year. It's great. It's super easy. Units of production is going to be our best method for items that are used differently every year. So again, our 3 methods here, I hope that all 3 of them make a lot of sense to you. Obviously, you're going to have to do these on homework and tests, so I wanted to go through an example so you could see me work all 3 of those. And of course, they're all 3 used for different reasons. Thank you.